Hello, my name is Tim Kraus with Kraus Accounting Group. If you are looking to potentially sell an accounting firm or buy an accounting firm, what's the mix of price and terms, and how does there's the balance between the two of those when you're looking at actually doing an acquisition or selling your firm? How do those come into play? So we're going to dive into here, price versus terms and the balance of the two. I come from the real estate world before accounting, so this is something that we did quite a bit with different acquisitions here. So basically every deal has two different levers. One is going to be the price and one is going to be the terms. So the price is pretty self-explanatory. It is essentially just the actual dollars. The actual dollars in the deal. The terms are essentially things that are not dollars but are still valuable to either the buyer or to the seller. And there's a general rule of thumb that goes from basically, if you have the buyer's price, you can have the seller's terms, or the seller's price and the buyer's terms. That's kind of a generalized rule of thumb. I like to think about it kind of like a little line graph, because I work in a lot of line graphs. I do enjoy a lot of line graphs here. So if we have the seller and the buyer, and if we have price and terms. Okay, we got this here. In general, we have the four different scenarios. We have the seller's price and the seller's terms, and then we have the buyer's price, and then we have the buyer's terms. In general, they work like this. You have an X going here. That's a fun squiggly looking line. You have a line going there and a line going there. So if the buyer, in this scenario, once their terms, they're going to have to go with likely the seller's, with the seller's price, which will be right up in this scenario. So that could be the, hey, I want to pay over a long period of time, or I want a lot of seller involvement in the actual transaction, but I'm willing to then therefore pay a higher price. I have been on both sides of this. I have done one where it was very much the seller's price, and I've paid multiple times the SDE of the business. I've also done other ones where I have paid much lower, I'll keep the colors the same here. I've paid a much lower price point, but it was on the seller's terms. The seller wanted to get paid out in 1 year, and they wanted minimal involvement. So that's kind of the balance between those two as far as in how much a buyer, which I'm typically a buyer, is willing to pay versus how much a seller is willing to then balance that out with different terms. So generalized rule of thumb here, in general, the bigger the firm and the more sellable it is, especially if the operations can be that way. So if you have more leverage on that side, if you're selling a firm, then yeah, you can move a lot more towards price if you're willing to. But on the opposite direction of that, being a buyer in this situation, the messier the transition, the more of it that's in the owner's head, which is more risk. Also, if the owner is the only one with all the relationships, that's more risk. The more the buyer will have to push towards the terms or move towards the terms of the deal in order to help that risk, because it's a riskier transaction. So what terms actually mean? Again, a generalized one is going to be non-cash, non-price, non-cash items that are valuable to one party or to the other party. So a very important term for me that I've done I'm in my fourth acquisition right now. But I've done 3 acquisitions previously, fourth one currently going on right now. And the seller's involvement has been a huge factor. I've done deals where the sellers had almost no involvement, just the very beginning, and they were gone. I've had other deals where the seller is still involved, and he'll be involved for about another month, and then that'd be 1 year of involvement to be able to help things go over. So that is a big range there, and the multiples reflect that, because that has a lot more work for the seller in that. But in general, a rule of thumb, the more work the seller is willing to do is the more risk reduction, and thus therefore a higher multiple at the end of the day. And the multiple is just the multiple times the profit of the business. So you can buy it by any number that you want. Some people do it by gross revenue. I do by a multiple on the profit of the business, because the more profitable your business is, I believe you should be compensated for that additional profitability. So, but again, we have very light support email, and we've had those before. We've had medium, transition days, joint meetings, and then I've also had situations where I have gone for a full year with the actual accounting firm owner. So, another term that is very important is the client fit. This one has been a learning process for me, for sure. But essentially, with the clients, what's their current price point and what are their expectations? I have a sheet I'll go over at a different time for when I'm buying a tax firm, a small tax firm acquisition, of basically mapping out the entire flow of the client's process. We do, in general, what we call digital first right now in my firms for taxes. But there's a lot of firms that do paper only or primarily paper. Those are different expectations. Those are going to have to be worked through at some time. And so that is going to be more work for the buyer in the whole scenario. So in general, the better you can have the expectations towards, if you're selling to someone else, they probably have a more modern firm, because they're looking to continue to grow. Therefore, the closer you set the expectations to more modern things is probably better. Also, one thing that is really painful, we've gone through this before, and it makes the client list less valuable. And this is when we're buying a client list, not necessarily a whole separate business, but just a client list we're going to do a tuck-in, is going to be having pricing that's far below the market. Because very likely, especially the buyer, now they're going to have to take on the business with a debt load. They're likely going to have to be raising up those prices. And so that is taking on risk. So yeah, repricing risk is a real thing. In general, I reprice a couple different ways, but one of them is I have a standard price raise and I have a catch-up price raise, which is a higher percentage, and I will catch up people on the prices over like a term of 3 years. Some people, when they buy a firm, they will just come in and let heads roll and basically have everyone go to market price or go somewhere else right away. I'm not a big fan of that. I'd much rather slowly bring people over a several year period. But in general, the better you can have the price point and the expectations of your client closer to the potential acquisition firm, the better. And if you're buying an accounting firm, this is something you have to take into consideration. I have not taken into consideration this before, and it's bit me real bad. A lot of not fun phone calls. So this is something that you have to work through. Essentially, the cleaner the alignment, the smoother the retention, the better the economics for the buyer and for the seller. If we again look at here, if we have the seller and the buyer side, and we have all of these clients that I'm going to have as these little dots here. Check out my art skills. Essentially, if the buyer has all their stuff up here, and if the seller's here, the transition piece is going to be very large for all of these little ants in this scenario to transition in the expectations and changes. If, however, the seller is, as it says on my logo, building a firm to sell, they should have, in perfect world, been raising their prices, raising all of their expectations. So when they sell to the buyer, there's a much smaller transition. The actual amount of space here, this gap, is much smaller. That's like an I and a 3, but is much smaller than this tiny little gap up here. This is important also for me as an accounting firm owner right now, with our 2 locations and nearly 20 employees, is I have to make sure that I stay in line so that I have clear expectations for my clients, that if and when I come to the point where we want to sell or want to move on, that we can then have a much easier transition for our clients then. It's much better to do these moves over 10 years at 3, 4, 5%, especially price moves a year, versus have someone come and do a 25% price move. It's a lot easier to have better retention. Another essential debt or another term is going to be the tech or the process capabilities. This is where I've mentioned before, but paper heavy is very common in the accounting industry. I mean, not too long ago, that's all there was. But now we're doing a lot more digital things. So the more you could transition your clients this way, COVID actually helped out a lot of firms with this, moving things more remote, the better options you have. I mean, if you're an accounting firm seller, and if you have a totally remote accounting firm, you could sell to anyone in the country. That's a lot more potential buyers. So just being honest, like, this is very valuable. I know it seems annoying, and it is, but if you want to increase the value of your accounting firm, doing stuff like this is huge. Another thing is software migrations. Like, for example, we bought a firm, we're going from QuickBooks Desktop to QuickBooks Online. I know people hate online. I know people hate desktop. I'm not here to fight that piece. I just run accounting firms. But migration, training, change management, all these are costs. All these should be taken into consideration if you're buying an accounting firm as terms, essentially, or as things that affect the purchase price of the business. Hey, you're looking at this business. Let's say you're a zero shop, but everyone's on QuickBooks Desktop. That's going to be incredibly hard. If you're a QBO shop and everyone's on QuickBooks Desktop, that's still going to be hard. Not as hard, but you need to have that figured in there. We're going through those transitions right now with 30 clients or so, and it's tough because things look different, and there's a lot of change management that we're happening right now. Literally right now. Hopefully, if we get it done by March, we won't have to renew our QuickBooks Desktop license, but it's the end of January. It's not looking good. One more year. So the more conversion work that has to be done, the lower the multiple the business is going to be. So essentially, lower price or the stronger terms or both. And that's stronger terms in this scenario for the buyer if you're going to have more conversion work. Another one, this one is a very big one, and this is financing structure. All the deals I've bought have had some form of seller financing, some little, some up to 100%. So this is a very important one because, yeah, you can get SBA loan. I'm personally not going to do that unless it's a very particular sort of deal. And if you're looking in buying small accounting firms, especially where the owner is still involved in the day-to-day, I would heavily guard against that. That is very risky because there's a lot of transition. And accounting is a super relationship business. I know it has numbers and spreadsheets and level those things, but it's a relationship business first, all those things second. So these are some terms you can have. In general, again, the higher the down payment, the lower, typically for me, the lower the price I would be looking at. I have had ones where there were no down payment, and I actually paid a much higher price for the actual firm. So, and then seller financing amount, again, going back to the drawing here of the seller and the buyer and the price and the terms. Okay. If you offer as a seller more seller financing, that means that you're going to be able to offer for a price that is more in line with what you're looking at. I think I flip these around because I have more of the buyer's terms there and then the seller's price. So keep that in mind. Also, from a buyer's perspective, you're looking to buy an accounting firm, and I do this as well. From a buyer's perspective, looking at, okay, I'm willing to pay 3x SDE for zero down, seller financing, 100% seller financing, or maybe and there's a lot of other factors too, so I'll just say that one, or I'm willing to pay then 2 times SDE for 15% down and 80% seller financing, or 70 or 50% seller financing, and then get some of the rest of it in SBA loan or whatever from there. Again, not a fan of SBA, especially for when the owner is still very much involved. I've only bought a firm so far that's up to 4 people. So I haven't bought bigger firms than that. When I buy bigger firms than that, I will let you know if that changes for my rulings on bank loans. But that's kind of where I'm at right now. And then also there's contingencies tied. This is, again, if the owner is involved, primarily involved in the relationships of the clients in the firm you're looking at buying. Very important. This is also why, as a seller, it is so valuable and so hard to transition all those client relationships. We've had some firms we've looked at where 0 relationships have been transitioned, and we didn't even look at buying those because when you buy them, the owner leaves, and then you have to transition all of them. And for those, we do more of a mass referral relationship. And then other ones where the owner had, a third, 40% of the relationships. And that one we've been working out, for the past year. So having contingencies tied to retention or collections is important for a buyer. Also, as a seller, it keeps everyone in line, because what you want is your clients to be taken care of well in your current establishment, in your current business that you're selling. This also means that as a seller, it is very important to make sure that when you're looking at a buyer, that you believe they're going to be taking care of your clients well, that they have the same values or very similar values to what you have, so that your clients don't have too much of a transition. There will be a transition because any buyer, no two people are the same. We are all unique. But any buyer is going to be different than you ran it as a seller. We're in a different time, different tools, they're different personality. You're just trying to see if at a high level, if their values align, so that then you are confident that your people will be taken care of. So, in conclusion, this framework, which is kind of this little X right here, shows kind of the flexibility. If you have a goal to maximize your final valuation, you can do things to build in strong transition terms, which would be like offering better financing to the seller if you're selling your firm. Keeping up with the technology, keeping up with market pricing, so important. Because then your buyer is so much more confident people are going to stick around because it's the same price. So these are all the factors that you can add in that are going to affect your price of selling, which is great. However, on the other hand, if you just need to get out, if you want to get out, if you want it to be swift, that's fine. You will just have those terms on the other side of the fence. And I have bought accounting firms from clients or from sellers, all different ranges in here. I've bought one where something happened and they needed to sell in 2 weeks. Okay. I bought other ones where they didn't need to sell, and so we took a year. It's all a balance between those two things. That's a very big term, transition of the seller. Very, very, very big term. So both of these, the price of terms, both totally can be a win for you or for the seller and for the buyer. It's about choosing the level that fits your goals and your desire for how much work, especially as a seller, you want to do pre and post the selling of the firm. And actually for the buyer too, this applies for both. How much work do you want to do, accounting firm buyer, me in this case, or other people watching this who want to buy accounting firms, how much work do you want to do after you buy an accounting firm? Because besides the normal day-to-day work, which we all do, besides that, there is also a huge factor of, are you okay repricing every client by a lot, or taking 3 years to do that? And you're going to have less profit for those 3 years while you're still paying back the debt. Are you willing as the buyer to put up with those technological changes that let's say you're a tax firm and you want to buy another tax firm, but the other tax firm is 100% paper and 100% in person and you're mostly digital. Are you going to be willing to do that? Are you going to be willing, like we're doing with our firm, with the one we just did here, to set up 15 in-person days, even though we're mostly digital, to have in-person meetings to help transition those clients? Because having those clear expectations, so that, again, going back to my little bridge analogy, this is ultimately what both of us want. The seller wants this and the buyer wants this. They want the clients, okay, to be able to make it across the bridge. This is a really crummy picture, but that's essentially what both parties want. So what work are you as a buyer willing to do after you buy the firm? That's a real question that you have to consider. What work are you as a seller to want to do now to help your firm be more sellable? That's another question you have for yourself. So that at the end of the day, hopefully we can build a firm to sell it, because all of us are transitioning at some point, whether we're selling it outside or selling it to a family member. And then we need to know the workload so that we can buy a firm to build your business. It's a very good way to do that. It's a very quick way to do that. I have videos on this channel of what happened for me in 2025, going from $500,000 to $1.5 million. About 600,000 of that was through just acquisitions, and the rest was through organic growth because I do that as well. But it is what work do you want to put into it? Anyways, my name is Tim Kraus with Kraus Accounting Group.